Hello and welcome to our live session today with Peter. So, I understand the Powell's speech was a market mover yesterday.
Yep. Powell's speech was the main event of the markets which defined directions for a number of trading instruments yesterday. Fed Chairman Powell practically allowed for the scenario that the bank will be proceeding with a narrow rate hike in its next meeting, and practically also warned that rates are expected to remain at high levels for a protracted period. Possibly they will be higher than what Fed policymakers were estimating in the September meeting. Overall, though, I think the main element which stood out was the idea that the Fed's going to be slowing down its rate hiking path, which more or less confirmed market expectations. It was characteristic that Fed's futures more or less imply 91% probability for the bank to proceed with a 50 basis points rate hike in the December meeting. The announcement as such, I would say, definitely weakened the US dollar. On the other hand, though, it allowed for gold's price to benefit. And at the same time, also US stock markets were on the rise. It was characteristic that Nasdaq, Dow Jones, and S&P 500, all three of them were in the greens, rallied. But in my opinion, that was not the only news coming from the US yesterday. We had also the release of the second estimate of the US GDP rate for quarter three. It came out better than expected. It accelerated to 2.9% if compared to the first release of the GDP rate for quarter three. And that was on the positive side. And I would dare to note that may also enhance the idea which Fed Chairman Powell had expressed in the past, that the US economy may be entering a very mild or even shallow recession. So that was a positive. On the flip side, we had also the ADP employment figure, which dropped substantially more than expected. And if I'm correct, it was at 127K, which tended to intensify worries about the US employment market. And speaking of the US employment market, we have to note here that Fed Chairman Powell yesterday made an interesting comment where practically he stated that the US employment market is in short supply. And that's a big issue, as that would practically, in our opinion, make the Fed's efforts to actually curb inflationary pressures a little bit more difficult, as that would imply that practically should there be a short supply of labor, wages may continue to increase at rather high levels, and that could more or less continue to feed inflationary pressures. So it's not only the speech as such, but there were a number of elements which tended to create different worries in the markets yesterday.
And what's new in Europe?
Yesterday we had the release of Eurozone's preliminary HICP rate. It was for November. The rate as such slowed down more than expected. And market expectations that inflationary pressures in the Eurozone have peaked and may be now on the retreat have intensified. And such a conviction could practically more or less ease the pressure on the ECB to actually proceed with another jumbo rate hike in its next meeting. So I think, though, that inflationary pressures are still high, and the bank is going to proceed, maybe not with a jumbo rate hike, but definitely another rate hike plus a tightening on a quantitative level. So we may see the bank retrieving some of the money it had lent out in the past, or at least plan how to do that.
How about China?
In China, we had a shift in the tone of the government. About COVID, it was characteristic that in the past the Chinese government had highlighted how dangerous the virus is, etc., in order to also more or less justify the strict measures which had been taken. Yesterday we had some comments by Vice President Sun that practically the pathogenics of the disease seem to be easing. And that would be a notable shift in the tone of the government, which may allow for more districts to ease their COVID-related measures. Now, should that come into play on a more extensive manner, we may see practically economic activity being revitalized in the Chinese economy, which could be good news for the global economy as well.
What's on the calendar for today?
Well, we already had a number of releases. We had the UK's nationwide house prices, which dropped into the negatives, and that was definitely a negative for the pound. It was expected to improve. It dropped deep into the negatives. And the lack of demand may be one of the main factors for the dropping prices of houses in the UK. That is also indicative of the dire economic situation of the UK right now. Other than that, I would be noting today in the American session, definitely the consumption rate. And I would be highlighting the ISM manufacturing PMI figure. It's for November. It's expected to drop below the reading of 50. And such a reading could imply a contraction of economic activity for the US manufacturing sector. I think it's the first post-pandemic one. And would be a little bit worrying in my opinion. Could weaken the US dollar somewhat, but could also hurt the market sentiment, which currently supports US stock markets.
And what's up on the monetary level?
Well, we have a number of speakers. I would make a start in the American session with Dallas Fed President Logan, and I would also be noting Minneapolis Fed President Kashkari and ECB Chief Economist Philip Lane. Especially, I would be highlighting the last two. The Minneapolis Fed President Kashkari was quite hawkish in the past month or so. And should he be reiterating comments in a similar tone, we may see the US dollar getting some support. During tomorrow's Asian session, we're getting comments from RBA Governor Lowe. So Aussie traders should be on the lookout here, as well as ECB President Lagarde, which could affect the euro somewhat.
And any final comments for today?
Well, we had an interesting day also for oil. We had another jumbo drawdown of US oil reserves yesterday, which tended to provide some support for oil prices. And mind you that oil traders are already shifting their focus towards OPEC's meeting that would be over the weekend. And should OPEC show that it will be curtailing production levels substantially, that could provide additional support for oil prices. I would be highlighting though that overall the market's attention is shifting towards the US employment report for November tomorrow. The NFP figure is expected to drop substantially. The unemployment rate though is expected to remain unchanged at 3.7%. And average earnings are expected to slow down. Overall, despite the unemployment rate remaining unchanged at 3.7, which is relatively low and implies that the employment market remains tight, the drop of the NFP figure exactly highlights that the US employment market is slowly but steadily losing its ability to actually create new jobs, and that's worrying and could weaken the US dollar. At the same time, by the way, we're getting also Canada's employment data. They are also for November, and in this case, the employment change figure is expected to drop, and the unemployment rate is expected to rise to reach, if I'm correct, 5.3%. Both indicators are aligning, signaling that the Canadian employment market practically is loosening up, and that could weaken the CAD.
Thank you, Peter. Stay tuned for our next live session with Peter.
Welcome to the technical analysis part of the presentation for today. My name is Peter Yusuf. I'm the senior market analyst at IronFX. Now, in front of your screens, you have the US dollar index for our chart. All charts to be presented are to be of the same time frame unless otherwise stated. With no time to waste, we note that there was a drop of the US dollar index from the 107.15 resistance line, breaking just below the 105.55. Now, there was a big question arising whether that was a clear break or whether that's a shift of the first support line. We tend to be with the latter scenario, thus we're going to be correcting the support level. Note how the low, the true here during today's early European session practically is exactly aligned with this one. And that's a verification. So in our opinion, we're still in a sideways motion. And let's correct the S1 at 105.25. So on the other hand, though, I would be noting at this point that on a technical level, in my opinion, two elements stand out for the US dollar index. The first is that the RSI indicator below the 4-hour chart has dropped considerably and is now at the reading of 37.9, that would be almost 39, and more or less tends to highlight the bearish sentiment in the market for the dollar. The second is that the price action dropped, and practically the drop was halted or slowed down if you prefer, once it had hit the low Bollinger Band. So the question now arises, are we still in sideways motion or are we about to enter bearish outlook? For the time being, we tend to maintain the bias for the sideways motion to continue between the 105.25 and the 107.15. For us to adopt a bearish outlook, we would require a clear breaking of the 105.25 support line, practically having a lower true than this one, somewhere here. And that would be signaling the beginning, if you prefer, of a bearish outlook for the index. In such a case, we may see the price action dropping breaking the 105.25, which, mind you, found support here in the European session early today, found support here and here. And in that case, we may see the price action paving the way practically for the 103.50 support level. Let's have a check where the R2 actually rests. Beautiful touches here and here. Pretty valid. Let's have a look also at the S3 once we're here. Nice true here. Okay, we're keeping them. So on the one hand, sorry for that. On the one hand, we tend to maintain our bias for a sideways motion, and we would require clear breaking of the 105.25 before actually switching into a bearish outlook. I would be noting one small comment. Thank you for the nice comments, by the way. And be aware. It's a word of notice here. It's a word of warning. Be aware of the bearish tendencies. They could be reignited, and in which case we may see the US dollar index actually dropping below the S1 and start aiming for the S2. On the other hand, the possibility of a bullish scenario, in our opinion, is not probable. But it's still a possibility which we should cover. And now for us, for the US dollar index to actually break above the current sideways motion, it would mean that it would have to rise, break the R107.15 resistance line, which marks a peak here, here, and here, and start aiming for the 109.10. It's a quite improbable scenario, but still the possibility is there, and we have to cover it. Let's have a look now at Euro USD, which should be on the rise. In a very similar picture, it rose, but it was not able to actually escape the boundaries of its current sideways motion between the 1.0325 and the 1.0485. So we maintain our bias for the sideways motion to be maintained between the pre-mentioned levels. We may see the price action moving like this. On the other hand, should the bulls actually take over, given that there seems to be a distance building up between the price action and the upper Bollinger Band, and also given that the RSI indicator is pretty high, it's currently at 60.4, that would allow the price action to rise, break the 1.0485, and aim, if not even breach, the 1.0605. So practically we have here the possibility of a bullish movement, yet for that to come into light, we have to see the price action breaking the R1 before moving forwards. On the other hand, should the bears take over, we may see the price action reversing direction, dropping. We would require clear breaking of the S1 1.0325 and the price action to start aiming for the 1.0220. All scenarios are possible for the time being though, and as long as the price action remains between the 1.0485 and the 1.0325, we tend to maintain our bias for the sideways motion to be maintained. Let's have a look at cable. Let's make some slight corrections. It's interesting how the pound is weaker than the euro in this case. You can see it as they both test the US dollar. The euro has corrected, has stabilized somewhat. The pound is still on a weakening, on a strengthening path. Sorry, it's the reverse direction. The pound seems to be about slightly stronger than the euro. There's still an upward momentum here, but it seems that cable, and we can see that more clearly in the 1 hour chart. Let's drill into the 1 hour chart. It seems to be finding a ceiling, has to be hitting a ceiling at the 1.2150 resistance line. It's going to be an interesting question whether the cable will be stopped by 1.2150 as it was stopped here, or whether the bulls will have the strength to actually advance further. Now, in favor of the bulls is definitely the RSI indicator, which is currently at rather high levels at 61.9, it's almost 62, which supports the idea of a bullish sentiment in the market for the pair. On the other hand, though, we have to note that the price action has reached, even rose slightly higher, just a bit above the upper Bollinger Band, which are slowly starting to diverge, and that may slow down the bull somewhat, allowing for the pair to stabilize a little bit. Nevertheless, as long as the price action has not broken clearly the 1.2150 and remains between the R1 and the S1 1.1940, we tend to maintain a bias for a sideways motion. Yet should that be not the case, say for example, if the R1 is clearly broken, and I highlight the bullish tendencies here, we may see the price action rising, breaking the R1 as mentioned, and start aiming for the 1.24 resistance level, a level which, let's have a look how far back it goes and where it rests actually. It was at this peak here. It's a nice reversal. See how steep downward, upward the motion was and was reversed. It had hit a ceiling at the 1.24 here. But it also was the lower boundary of the sideways motion. It was also tested here, so it's pretty valid. Also tested to the downside. I'm keeping that. So for a bullish outlook, we would require a clear breaking of the R1 1.2150 and the price action to start aiming for the 1.24. Now for a bearish outlook, which does not seem to be the case, but still it's a possibility, we may see the price action reversing direction, dropping, breaking the 1.1940 support line, and start aiming for the 1.1705. It's pretty low, but given the pound's volatility, could be covered within 24 hours easily. Let's have a look at USD JPY. In my opinion, USD JPY has a very different course in relation to the US dollar than other currencies. Let me readjust the charts here. We can see that there was a steep drop, pretty wide, a clear break of the first support line, which provides support here, so that was pretty valid. It used to be. And reached even as low to reach the 135.80. Didn't have the strength to continue lower, correct a little bit higher, but still it reached that low. It would be quite interesting if we drilled into the 1 hour chart. See how there was a nice downward shift, which practically reached as low as the 1.35 before correcting higher and stabilizing. So for the time being, we tend to maintain a bearish outlook given that the 1.3750 was clearly broken. But before we move on, let's make the necessary corrections in the support and resistance lines. Definitely the S1 137.50 has now been turned into a resistance line, given that the price action has broken clearly below it. Let's go hunting for a new ultimate support level. Unlocking the chart. This is a nice show. See how the price action dropped steeply, hit the floor, and that was at 131.50 and bounced back up. It's a beautiful V-shaped reversal here of the pair's price action, which cannot pass unnoticed. And let's correct this, 131.50. Yeah, 131.50 it is. Plugging this in green. Let's have a look whether we have more verifications. It was aimed for here and here. Okay, then it was decisively lower. So I'm keeping that. Seems to be pretty valid. We had a clear touch and an aiming. And let's make the necessary corrections also on the labels. Making a start with the R3 at 142.15. The R2 is now being placed at 139.65. The R1 at 137.50. It used to be a support line, but given that the price action has moved decisively lower, it switches its role from its support line to resistance line. First support line now being placed at 135.80. Second support line at 133.90. And final support line at 131.50. Now we have mentioned that the price action has a clear downward direction. Two words of warning here about that bearish outlook. The first warning comes from the RSI indicator, which dropped slightly below the reading of 50. It's actually at it's almost at 30 right now. It's at 29.8, which on the one hand surely is showcasing the strength of the bears for USD/JPY. On the flip side, though, may also be implying that the pair may have reached oversold levels. The bears got a little bit ahead of the reach here. And in such a case, we may see the pair correcting a little bit higher. We get a similar warning also by the Bollinger Bands. See how the price action dropped, broke the Bollinger Bands here, dropped below it, and after breaking the Bollinger Bands, it slowed down and seems to have almost stabilized. It has even corrected a little bit higher after touching the 135.80. So that may slow down the bears even further up until enough distance is being built between the price action and the dropping lower Bollinger Band in order to allow for the bears to have more room to play. Possible stabilization could be. Yet, should that be the case, and given that the price action was stopped at 135.80, we maintain a bias that the stabilization would be between the S1 and the former S1, the current R1, 137.50. So it would be movement in here. On the other hand, should the bulls take over, we may see the price action rising, breaking the 137.50, start aiming for the 139.65 in an effort to recover practically the lost ground of yesterday. Once again, though, for the time being, main expectations are for the bears to maintain control, in which case we may see the pair in the next 24 hours dropping, breaking the 135.80, and start paving the way for the 133.90 support level. Let's have a look at the other safe haven currency pair, that would be USD/CHF. Okay, the situation here is a little bit more complicated. Now, yesterday, USD/CHF stabilized, breaking the upward trend line guiding it. and that renders the upward trend line useless. So let's delete that. It's interesting to note that the price action has dropped below the 0.9495 support line, now turned to resistance. We have to correct that, and seems to be stabilizing. So before any more comments, let's correct the S1, turn it into a resistance line. And let's go hunting also for a new ultimate support level. Let's unlock the chart. Now we have a touch here, which may be somewhat valid, I'm not saying no, but we have multiple touches lower down the road at this level, these ones. And practically these two levels encapsulate beautifully the sideways movement. The channel within the price action was moving. I'm thinking this is definitely more valid than the previous one. So I'm keeping this one. And it would be in green, the 0.9150. Okay, nice round figure. Let's correct the label so we get a clearer picture. Okay, the R3 now is being placed at 0.9735. Second resistance line at 0.96. First resistance line at 0.9495. First support line at 0.9395. 100 pips distance. Second support line at 0.9285. And final support line at 0.915. Given that the price action on the one hand dropped, okay, but it seems to have failed to continue any lower, at least for the time being. We tend to maintain a slight bias for the continuation of the stabilization, possibly between the 0.9395 and the 0.9495, in a similar sideways motion like here or here. On the other hand, though, the RSI indicator is correcting higher. Okay, that's a good one. Also in favor of a sideways motion, given that it has reached almost 42. Should the bears, though, take over, once again, I wouldn't be surprised to see the price action dropping, breaking the 0.9395 support line, and start aiming for 0.9285. On the other hand, should the bulls be on the rise, we may see the price action rising, breaking the R1, and start aiming for the R2 0.96. Interesting chart. Let's have a look at commodity currency AUD/USD, currency pair AUD/USD. Now AUD/USD was on the rise, breaking above the 0.6795. A very interesting question. But allow me, before making any comments, to make necessary corrections on the resistance and support lines. Definitely the 0.6795 is to become, initially at least, a support line, given that the price action is above it. Let's go hunting for a new resistance level. This level here cannot be missed out. And that would be in red. The 0.7130. Let's have a look if we have another verification here. We have a second one. And the next one is up here. Okay, seems good. Keeping it. Let's make the necessary corrections also on the labels. Making a start with the S3, which is now being placed at 0.6545. S2 at 0.6640. S1 at 0.6795. R1 at 0.6915. R2 at 0.7040. R3 at 0.7130. I think we're set. Now, we saw AUD USD being on the rise, understandably given also the weakness of the US dollar. Maybe some were expecting a wider rise of the pair's price action. That didn't happen. And it even corrected lower during today's early European session. You can see the slight red candlestick there. Interestingly enough, on technical level, it corrected lower after breaking above the upper Bollinger Band, and as it hit the level of 70 on the RSI indicator below the chart, for the time being, we tend to maintain the bias that the bullish outlook may not be just over yet. And the main reason I'm saying this is practically the fact that the correction was not wider. It did not return immediately back into the realm of 0.6795 or below it. And the RSI indicator, despite correcting lower, it's still at pretty high levels. It's currently at 64, which is indicative of some bullish residue in the market sentiment right now. So should the bulls regain control, I wouldn't be surprised to see the price action rising and breaking above the 0.6915, paving the way or opening the gates for the 0.7040. Now, the distance between the current level and the R1 is practically at around 110, 120 pips almost. And something which I think can easily be covered by AUD USD within a day, if not even more. We're going to have to wait and see. The first threat, though, to the continuation of the bullish outlook is the possibility that the price action may stabilize. The correction lower may make the situation a little bit more permanent, and in which case we may see the price action practically revolving around the S1 0.6795. On the other hand, for a bearish outlook, I would require clear breaking of the S1 And the price action, not just to aim for the S2, it has to reach it, maybe even breach it. I would require a lower true than this one, somewhere here. And we're talking here about 155 pips. Main scenario for now could be a bullish outlook, but I highlight the tendencies for stabilization of the pair. Let's have a look at USD CAD. USD CAD dropping like hell, practically reversing the gains made in the day before. It's a beautiful chart, a beautiful reversal. Interestingly enough, it has broken the upward trend line, which was guiding it. Okay, let's make necessary corrections. Definitely the 1.3470 support line has been broken and has to be switched to a resistance line. That would be the first move. Locking this in. Let's go hunting for a new support level. I would be highlighting this one. Could go as low as this one. A little bit too low in my opinion. Here. See the touch here and see how it encapsulates practically the sideways movement here. It limits it to the downside. And that would be the green 1.3095. Yep. Let's readjust the chart. Let's correct the labels. Let's make a start with the R3, which is now being placed at 1.3610. Sorry, 85. R2 at 1.3570. R1 at 1.3470. S1 at 1.3320. S2 at 1.3230. And S3 at 1.3095. Taking this in. On the one hand, with the wide drop and the fact that the price action was able to break both the upward trend line guiding it, as well as the first support line, the 1.3470, tends to imply that the bears are in control here. On the other hand, though, we have to note that the pair stabilization tends to imply otherwise. That the pair has dropped and now has stabilized. It's interestingly enough that the RSI indicator has risen and it's actually right now at 46.2, pretty close to reading of 50, actually aiming it, which may imply some hesitation on behalf of the market. For the time being, I expect the pair to remain stable. On the other hand, though, the bearish tendencies could be maintained. Should the pair stabilize, I would expect it to remain between the 1.3470 and the 1.3320, something like this. Should the bears remain in control and regain control, if you prefer, we may see the price action of USD CAD dropping, breaking the 1.3320, and start aiming for the 1.3230. Definitely a break below the previous choice here will be required for a bearish outlook, in my opinion. Or at least a break below this one and a touch here. Now, should the bulls take over, and that could occur should the market sentiment improve substantially, I mean in the sense that it supports the US dollar substantially. That could be also on display should the price action of USD CAD rise, break the R1 1.3470, and start aiming for the R2 1.3570. Let's have also a quick glance at WTI. Okay, there's still some bullish tendencies here. Slight, but still. I wouldn't be surprised to see the price action start aiming for the 80 to 3.50. Oil's prices got some support also from the release of the EIA crude oil inventories figure yesterday. On the other hand, though, the easing of COVID measures in China may also allow for some hopes for the demand side of the commodity. But I think that the market is increasingly shifting its attention towards OPEC's meeting over the weekend. And should OPEC signal that it's going to be lowering production, that could have a substantial bullish effect on oil's price, which could push it higher than the 83.50 and start aiming for the 87. It's going to be interesting to see how the market will be reacting on Monday morning. For the time being, bullish tendencies are still present. From all of us here at IronFX, best wishes for solid trading.
Hello, my name is Christina. Fundamentals are all the qualitative and quantitative information that helps determine the financial value of a company, currency, or security. This information is included in fundamental analysis and helps define an asset's financial well-being. Macroeconomic fundamentals are topics that affect an economy as a whole, like microeconomic fundamentals are topics that affect smaller parts of the economy. Forex traders are interested in macroeconomic releases or fundamentals, which will help them assess the state of the economy and determine whether a currency will go up or down. Macroeconomic fundamentals include statistics about the jobs market and unemployment, supply and demand, economic growth and inflation, as well as monetary or fiscal policy and international trade. For example, a forex trader who trades the USD or any currency pair that includes the US dollar will closely follow any news from the US Central Bank, the Fed. The Federal Reserve maintains financial stability by increasing or decreasing the discount rate. The Fed sets target interest rate at which banks lend to each other overnight, but it also sets the discount rate, the interest rate at which banks can borrow from the central bank. If If the Fed raises interest rates, it increases the cost of borrowing to slow down the economy. On the contrary, in order to stimulate the economy, the Fed lowers rates, making borrowing cheaper and encouraging spending on credit and investment. When the Fed raises interest rates, as it's currently doing at an aggressive pace, it tends to favor the US dollar. Also, the more the Fed hikes rates, the more other central banks need to catch up by raising their own rates. This difference between different central banks' monetary policy also influences currencies. Other microeconomic fundamentals, such as major economies' CPI data, non-farm payrolls, gross domestic product, retail sales, purchasing managers' index, and others, can influence the value of a currency and create volatility. Thank you for watching.
Hello, can you guys hear me and see me? Welcome to another session with IronFX. My name is Annabelle. Okay. So welcome, Posthumous. Welcome, Deepesh. Hi, Juha. Hi. Welcome. Hello. Nice to see you guys. This is the first few session of the Forex Army together with IronFX. This is my first few session. So nice to see you guys. Let me know where you guys are tuning in from in the comment section. So I have another page that is open and I will be answering any of your questions if you do have any. So feel free to just post any comments, any questions while I go through the webinar. So let's give the rest of the attendees a couple more minutes before I start. So today's session will be the third part of the Fibonacci series, which is the Fibonacci expansion. Hi, Juhaya, you're from Finland. Okay. Peter, why have the markets been ranging? Which markets are you talking about? So maybe this couple of hours might be a bit sensitive because there's a big news coming on tonight, the CPI. All right, GU, maybe we can take a look at that later. So yeah, to answer, Juha, you're from Finland. I am tuning in from Singapore. Nice to see you guys. Oh, it sounds like it's raining right here. Okay, just a couple more minutes before we start. Maybe I should start with the risk warning. So our products are traded on margin and carrying a high level of risk, and it's possible to lose all your capital while trading. So FX may not be suitable for everyone, and you should ensure that you understand the risk involved. Disclaimer: the information in this webinar should not be construed as investment advice or an investment recommendation. So please practice your due diligence before you trade. And any material in this webinar is strictly personal opinion of us. The client's investment objective and risk tolerance have not been considered. So yes, please practice your own due diligence. Okay, we have a few more attendees. Hi, Mikhail. Okay, so let's start today's session on Fibonacci expansion. Okay, so the agenda, hang on, give me a sec. Okay, so for today's agenda, it's quite clear. I'll be touching on the third part of the Fibonacci retracement, which is the Fibonacci expansion. So this is quite an important tool because it's it's where we will catch the reversals, where you can fine-tune your entry or fine-tune your entry levels and your probably your take profit or your stop loss. So let me know if you have ever used the Fibonacci expansion. Yep. The agenda today will be, I will cover some parts on the ideal market structure. So it's kind of like a recap on the Fibonacci as a whole, in case some of you guys have never seen it or you have missed the past sessions. Following the trend line, the different retracement levels, Fibonacci, this should be expansion, sorry, and then Fibonacci levels below and above 100%, the live practice. Okay, so this is me, Annabelle. I'm from the Forex Army. As you can see, we are the finalists for Best FX Research 2019, 2020, 2021, as well as finalists for Best Equity Research 2020, 2021. Okay, let's start with the recap. So what is the ideal market structure? So what I mean by ideal market structure is that you need to make sure that there is a trend going on. So let me just draw. Okay, as you can see here, this is an ideal market structure. It's a very nice, bullish momentum right here. So you do not want to go to the 15-minute time frame to catch all the small waves because it will be inaccurate. So in any case, if you are using a Fibonacci retracement tool, we would highly recommend to use the 4-hour or the 1-hour chart because it's cleaner in this manner. Yeah. Okay. Okay, so for Fibonacci, to draw an accurate Fibonacci, we try to catch significant, maybe I go to the next slide first. We try to catch significant swings like this, big movements. Okay, because this will make your levels more accurate. We are looking for swing highs and swing lows. So usually these are captured in the higher time frame, meaning the 1 hour or the 4 hours. So what I mean by insignificant swings means probably if you are scalping your trades, you will be looking at 5 minutes, 15 minutes, or half an hour. So these swings are very insignificant because they're very choppy. You do not know where to start your level, where to end, where to draw your levels accurately because there can be so many levels here. So these are small, choppy, insignificant waves that we do not want. Yeah, please take note. Okay, hi Mabilo, hi. Hi Peter. Hi, welcome to this session where we are talking about Fibonacci expansion. Do let me know if you guys have any questions at any point in time. I will just answer if I have the time. Okay, so following the market structure, okay, while drawing your Fibonacci, you do not want to cut across like this. You do not want to cut across the chart this way, where you have a lot of gaps in between and the price are not close to the trend line. Yeah. So an accurate, maybe let me just show you guys some examples, some live examples. Okay, so in order to draw your Fibonacci, what we do is we will draw, let me go to a higher time frame. You want your trend line, which is this blue line, to connect as close as possible to your price. It shouldn't deviate much. So this is a very clean line that we are looking at, a very clean Fibonacci trend line that we're looking at. Instead of maybe instead of this. Okay. This might not be as accurate because of this part, which is a bit messy. Okay, so you try to draw as close as possible to your price. See the levels. Let me adjust this here. Okay. Try to be as close as possible to the trend line that you're going to draw for a more accurate Fibonacci retracement tool. Okay, back to, okay, so this is wrong because you can see that the gap is very wide. So this might not be a good Fibonacci trend line that we are looking at. So there are two rules that I always follow. The trend line must follow the price structure clearly, and the trend line can deviate, but not by too much. Okay, so in this example here, this line that they draw is very clean where the prices are following the trend line. So this is a nice Fibonacci retracement. Okay, so let me refresh your memory on the different Fib retracement levels. So we have previously already learned here. This is the Fibonacci retracement, which is between 0 to 100. Anything that is beyond the 100 will be your extension. So this one we are looking for the Nike tick. This is covered during the previous session. Later I will show you guys how you can find previous session on IronFX website, because these are all recorded. And today we are learning Fibonacci expansion, where it goes below the 0, meaning the negative zone. So these are called expansion. Just to give you some advice and tips, these are called, the whole series are called Fibonacci retracement. It's just that they are named differently, but these tools are used to find reversal points. So it can help you better fine-tune your entry level or your take profit stop loss levels. Okay, so let's take a look at this chart. Okay, like I've mentioned, okay, the 0 to 100%, these are called retracement levels. Yeah. So if the price reaches here, this is still within the retracement zone. But if price comes here and goes down, this is called the expansion. Alternatively, price could also, let me get my pen, hang on. Okay, price could also come back down here and go all the way up to the 100%, breaks this level and go beyond the 100 to the 127.2 level. So these are called the extension levels. Okay, please take note of these important levels. These are all key levels. Okay, so Fibonacci levels below 100%, and how do we use how do we spot the levels, and are they really useful? Let me know in the comment section how many of you guys have actually used the Fibonacci expansion. So in my opinion, actually Fibonacci expansion will not be as useful on its own. Mikhail, I've used the retracement. Okay, that's great. But have you guys used the expansion before? So in my opinion, I feel that expansions are not useful on its own. It's not very effective. It has to be used with all the other retracement tools like your extensions and retracements. So at the end of the four sessions, you guys should know how to use it all together, where we can use the confluence to fine tune all our entry levels or take profit. Okay. So some examples before I go to the live trading charts. So I have put in some effort to go back in time to find some of the good examples that can simplify what are Fibonacci expansions to help you better understand it. So for Fibonacci expansion, you can see here, I think this is, let me see. This is GU. Okay, so just now someone, Peter, you have mentioned GU. Okay, this one would be GU, but probably in July. So this example you can see here. Okay, for Fibonacci expansion, we are looking for a retracement of at least 50% and above. Yeah, 50% and above. So point number one, we will be looking for a retracement level of more than 50% before we consider that as a strong or effective expansion. So right here, you can see my Fibonacci retracement tool I have drawn from here to here, and then it has already corrected more than 50%. So it's that it has slightly broken my 78.6. So once it has broken or tested anything above 50%, you will look for a reversal. You wait for a reversal to come back. And at this point, then you will take note. So number one, it has to retrace more than 50% and then bounce back to test at your 0% before I will take note of this trade to call it an expansion. So essentially what you are looking for is a flash. Yeah. So for expansion, we are looking for a flash. It can be downward or it can be upward. So long as it expands, it retraces more than 50%. Okay. Retraces more than 50%. 50 to 100, not more than 100. Because if, for example, if it retraces, let me erase first. For example, if your price comes here, retrace more than beyond here, beyond your 100%, this is called an extension already. So your expansion will be invalid. Yeah. Okay. Mikhail, your question, expansion continues the original direction. Yes, it does, meaning to say, okay, so if it's a downward trend, right, it will look like this. It will retrace more than 50%, and then we are looking for it to go back down to the 0% level before it captures your attention to go to the -27 before it bounces up. So here is very clean. Later, I will show you guys some of the live examples. Okay, these are the ones that I screenshotted to make it easier and faster for you guys to grasp the basis of it. Yeah. So let me try on another. Okay. Okay, this is another example. So this is also GU. Like I've mentioned, okay, your Fibonacci retracement tool, you draw it. It has to retrace, number one, 50% or more. So in this instance, it has retraced already at the 50% mark. Okay, so we're looking for it to reverse and in continuation with this trend. Meaning I'm looking for this. So anyone can tell me what will happen next if this is Fibonacci expansion. What should we be expecting? Let me know in the comment section. So like I've said, we're looking for the flash. Okay, I have some comments. Yes, it will go in this direction. Let me show you guys. Okay, so just now it came back down to test here, right? And then it goes up to the 0% level, which we are looking for. So the two things we're looking for is for it to retrace more than 50%. And then second point would be that it touches the 0% level. So at this point in time, when it touches, you should get an alert, or you should take note that if it goes beyond here and touches the minus 27.2% level, it should bounce off. So usually, for my take, how I trade is, at this level, I will wait for it to come to this zone. I will wait for a confirmation that is going upward. Obviously, I will use other tools like my retracement or my extension, my projection, and maybe other key levels to make it a more accurate trade. But in general, once it breaks off here, it's time for you to take note. And if it comes to the negative 27.2 level, I will take a short. It can be long as well, depending on how you draw your flash. So it can be this, or it can be a long. So depending on which way you draw your flash. Okay, to answer Mikhail, why would it bounce off there? These are all, so like I've mentioned in the first part of the session, retracement tools are used for projecting forward and for you to note where the prices are going to reverse from. That's why it will bounce off here. So these are all the levels where we are looking at for prices to bounce off. That's why it's called a retracement tool. Okay, I hope I answered that. Okay. Let's try more examples. Okay, so if you guys have any requests, do send in the chat as well, because I have one screen that is catered to answer your requests or your questions. Okay, so this is USD Swiss franc. Let's take a look at this. Okay. So number one, when you are using an expansion tool, make sure you draw your Fibonacci trend line correctly. It can deviate, but not to a huge extent like maybe this. This is too much. Yeah. So we try to make it as clean as possible. This way. Okay. So point number 1 for an expansion, you need it to retrace at least 50% or more. So this has already reacted 61.8% here. Reacted off and it's coming back. So this should look like a flash, like this. So what we are looking for, or what we are projecting forward, is for price to come down here. That's point number 2. Point number 1, retrace 50% or more. Point number 2, test the 0% level. Okay. So once it has tested, you will wait for a confirmation that is still going downward. Okay, this has already broken the key level here. So there's a downward confirmation. You will wait, probably an entry here. Might take profit. You could actually short it, or you can wait for reversal as well. So depending on which one you're more comfortable. Usually, if we are trading, I will go along with the trend. So if it's going in a more bearish manner, I would take a short here, take profit at the minus 27.2, because most likely it will reverse from here. Okay, to answer Mikhail, no, it doesn't always bounce off the minus 27. It could also go to the negative 61.8. So these are the two key levels that we look at. But for purpose of this webinar, I have taken most 27.2%. Yeah, you're welcome. So it's depending on how you chart and how you analyze your charts, because you don't only use the expansion tool. We still need to use extension, projection, retracement. You can use other tools or other indicators like your Ichimoku, your RSI, or your stochastic. So it's not just based on one tool that we make this decision to sell or buy. But these are all examples to help you understand Fibonacci expansion more easily. Huh? Okay, I think this might be the last few examples I have before I go to the live trading view. So right here, can any one of you tell me what we are expecting? I have drawn my Fibonacci trend line here. Okay, it's a bit messy, sorry. Okay, I have drawn my, I use a highlighter. Okay, I have drawn my trend line here. This is a very nice and very clean retracement trend line. Okay, so number 1, we are looking for prices to, yes, okay, it's not necessarily 50% only. So it's 50% or more. It could have came here and bounce off this level. It could have came here and bounce off this level. So anything above 50%, not just 50%, take note. So it could bounce off 61.8, or it can even bounce off 100%. So it's depending. So it could come all the way here and then just go up this way. Yeah. But please note that if prices touches the 100% and goes beyond the 100%, is expansion is invalid. Okay, it will become an extension. So anything beyond the 100% is an invalid expansion. Take note. Okay, so yes, to answer Mikhail, yes, we are waiting for it to bounce off the 50% here, or 61.8, or even 100. So it could be any levels, but yes, we are waiting for it to bounce off and goes in the direction of where your trend line was drawn. So you can see here, they bounce off. Can bounce off here. Point number 2, must touch. Sorry, my apologies. It's very messy. So point number 2, it has to break this level and then show signal and signs of a bullish momentum upwards. Then you can either buy here or you can short, because technically retracement tools are meant for reversals. So what you can do is also to short here, take profit. Usually I would just do it here because you will never know what happens after. Moreover, it's a very bullish trend. Yeah. What if it bounces off 38 or 23? Is that still good? Okay. If it bounces off, okay, let me draw it for you. Okay, let's say if, good question. So the reason why I keep emphasizing on the fact that it has to reverse off 50% or more, because if it just bounces off your 23.6% and goes this way, it will just look like it's in a bullish continuation. It's just making a higher low and in a continuation of this trend. For example, here, so come up, this is probably at 23%, and then it continues with a bullish momentum. So usually we don't treat it as an effective level at 23.6 and 38.2 because and also the fact that we have done quite a bit of testing. So it usually is most effective after the 50%. Yeah. Okay, so let me go to the live charts to show you some examples. Okay. Let me find a good example for you guys. Okay, we can try this. Let's try maybe US. If there are any requests, please send in. I can do it. Oh, shoot. Sorry, this one is slightly messy. Give me some time to load the charts. Okay, let's take a look at this. Okay. So let's try to use a Fibonacci expansion here. We'll try to spot some in the live trading view. So let's try. Okay, for expansion, remember you are always looking for a flash, meaning to say, okay, maybe I draw using a pen. So we are looking for a flash, okay, which is something like this. Okay. Let's see if there are any here. Okay, so this is quite a good example. Okay, just now, Mikael, you asked whether bouncing off the 28, the 23 or the 38 will be a good gauge. Here I'm telling you that it will not be quite a good gauge because usually it should react at the 50% or more. Yeah, so you can you guys see? Okay, this is a very good example that just happened a couple hours ago. Okay, price retraced 50%, and then it bounces off here. Tested my 0% here, breaks and come to the 27.2, negative 27.2. And then you see my take profit. So usually people will do it they will take a trade here or slightly below, and then the take profit should be at this level. Stop loss can be slightly above. Okay, this is how we usually use retracement tool to place our entry level, our stop loss, our take profit. So it helps you to fine tune it together with other tools. Yeah. Okay, so aside this, maybe I try to use all the tools together to show you what a confluence is like. Okay. So I'll usually draw a retracement first. Okay, you can see that it's reacting off the 61.8. So I will just leave. Where's my tool? Okay, I will leave the 61 because it's kind of testing here and it's rejecting. Okay, no use. Okay, what I'm trying to do here is I'm trying to give you a good example of a confluence where we use the Fibonacci expansion extension to fine tune where you should enter your positions. Okay, just give me a second while I find. Okay, so now price is right here at this 134.95 level. What I can do is, okay, it's kind of ranging, so it's very hard to predict what might happen, and especially if there is a big news coming tonight. So maybe this is not a very good example. We can do a back test. Okay. If you guys have any requests, please send in. I can see on my screen on the left. Okay. Okay, maybe we try USDJPY, then I will go to gold. Okay, no, this, okay, so maybe I'll give you an example of the extension. So you can see here, as you can see here, this is what we call an extension. So for example, if we do a, let's chop off. Yeah, so for example, if market is in this manner, yeah, I'm doing a back testing to show you some examples. Okay, so let's say if market is somewhere here now, what I would do is I would draw the retracement levels to see. Okay, so number 0.1, you want it to retrace more than 50% fulfilled because it has already broken the 78.6. I will wait for it to test here. Okay, so if it okay, as you can see here, it's already broken the 100%. So this is what we call the extension. So this tool will bounce off the 127.2 level because for Fibonacci retracement, they are reversal tools. So here, I would then try to see whether, okay, wait, number one is already broken, so you can't see whether there's a flash because once it's broken, the 100% is invalid already. So this is called an extension. But what you can do is, let's try doing this. So it retraces if See, so in this, okay, maybe I draw a cleaner line. So from here to here, we can see that it has sort of tested the 50% and rebound and bounce off this level. It doesn't have to always touch accurately. Sometimes if it's close enough, you can try to do the Fibonacci expansion. So what we are looking for here is this. And we have the also a bullish confirmation here this way. So I'm looking to see if there is a continuation. Okay, so my point number 2 would be once it's tested the 0% here, then I will keep a lookout for price to come here and reverse. It is not a 100% guarantee that it will always happen, but this is what the tool is for. So you will monitor. Okay, it looks like it didn't break this level, so this is not a valid expansion. Yeah. Okay. So what do you normally do? We have a question here. What do you normally do during the year, the end of the year when the markets are ranging? To answer that question, if markets are ranging, sometimes it also shows volatility, which is good for traders. But if you are not confident using the tools, or if you feel that it's too volatile, sitting out is an option as well, because being neutral is good instead of having to trade when you are uncertain. Yeah. Okay, when it breaks 100%, it's an extension or expansion. Okay, so when it breaks, let me clear this up. When it breaks a, let me see whether this is a good example. Okay. Let me just refresh this. Let me find a better. Okay, here. I think this is quite a good example. Okay. Okay, never mind. I'll explain from here. Okay, when 0 to 100 is your normal retracement where we look for prices. Yeah, let me just chop off. Okay, where we look for prices to bounce off these levels. So this is your typical normal retracement levels in between 0 to 100. Okay, so if price is already here, we are looking for a reversal here, the 38.2. If it doesn't, okay, maybe you can look at reversal at 23.6 or so these are all reversal points for you to take note. Okay, so if price doesn't break any of these levels and it goes, okay, and it goes below 0, it becomes negative. This is your expansion. Do note that expansion and extension doesn't mean it's in a certain direction. It's depending on how you draw your Fibonacci retracement. Okay, so just take note of the numbers. If it's between 0 to 100 is your retracement. Anything below is called expansion in the negative zone. Anything that is beyond 100, which is above 100, is called extension. So take note that it has nothing to do with which direction it is at. For example, if it's negative, it doesn't mean it's here. If it's more than 100, it doesn't mean it's here. So it's depending on how you draw your Fibonacci trend line. Yeah. And to answer your question, which time frame is best for this? I would usually look at H4, H1, or even on a daily chart. So usually what personally, what I do is I will take a look at the daily chart to see where is the market sentiment going. So it's currently, I'll use a normal retracement tool to draw. Anyway, for expansion, you also use the normal retracement tool. All these are drawn by using the retracement tool. So it's just how you read the numbers. So I would use a day to see where the market is generally going. So it's still in a bullish manner for USD JPY. Then I will zoom in. So here I also can see that maybe there is a potential for a expansion, but technically it's not that great because it's 23.6%. But if you zoom in, maybe you could have drawn here to here. Okay, kind of tested the 50%, didn't break. Yeah. Let's see where it goes moving forward. See whether this works. Just be patient with me while we try this. Oops. Is it? Okay, anyway, I'll use another. I'll just do XAU gold USD. Before I run out of time, I'll do a quick one on this. Anyway, yes, to answer your question, 1 hour, 4 hour is the best for Fibonacci. Okay, so here. Okay, right away, I am looking at this is quite a nice move. This, okay, remember, it always have to be significant. So we are looking at significant movement here, this way, yeah. So my chart would be something like this. It has already tested the 78.6. I'm looking for it to maybe touch here, bounce off, and then wait for it to test. Okay, this is slightly far, but this is technically what an expansion does. So I'm looking for it to test this level. If it breaks, then I'm looking to short here because this is the Fibonacci extension. Okay, it's at the 127.2%. So I'm looking, if it breaks here, I'm looking for a short here to come off. If it doesn't, and it becomes to test here, I will look for it to break this level first before I go to my Fibonacci expansion here, touches here, short it. Okay, but if you want me to do, okay, I don't think I have the time, but in general, this is what we're looking for the expansion. Okay, maybe I do a simpler one. Give me a sec. Okay, I'm at the 1 hour time frame. Okay, so what we're looking at is, remember the flash, right? So this looks like a nice flash right here, significant movement. Okay, we can try to look up for the, yeah. So here you can see that price has reacted off more than 50%. That's what we look for. Price has reacted, come off here, reacted off, and go in the same direction as where you draw your level Fibonacci. So right here, I'm looking for this price to maybe touch the negative 27.2 before it comes down. Yeah. Okay. I will see you guys in the next session. Thank you for tuning in. Thank you.
everyone, my name is Emily. In our video today, we will talk about why having a forex trading strategy is important. Trading on the global forex market presents the opportunity for a quick profit turnaround for traders and offers significant potential. However, as the most liquid market in the world, it is both complex and highly competitive. This means that in order to be successful, you need to have a solid trading strategy in place. Forex can be traded in numerous ways, so it is very important that you go with an approach that suits your experience level, budget, and trading goals. Having a proper understanding of the market you're entering into and the strategy that is needed can be the difference between trading success and failure. Choosing a forex trading strategy is similar to buying a new car. There are a lot of choices and they come in different types. It is also important that you test drive a new strategy via demo account before proceeding with it on the real world markets. Thank you so much for watching us today, guys. Bye.